Negative interest rates, we are talking about indication coming from the US bond yield market. The yields have reversed, which is a precursor to recession coming in US, and recession in US means problem for the world. But back home, the 10-year paper is sitting at 6.6%. Crude prices are lower, liquidity is coming back, fiscal deficit is not in a problem, but the bond yields in India have moved to 6.6%. So let's take this conversation forward as to why there is a disparity between what is happening in the world versus India. What should one read into this sudden yield reversal, and how should one anticipate and project global growth going forward? Laxmi Iyer joins us, CIO of Fixed Income Group with Kotak Mutual Fund. And we've got Sanjay Mathur, Chief Economist, Southeast Asia with ANZ. Laxmi, good morning. Thank you for joining us. I guess the introduction was the question in itself that local bond yields have gone higher from 6.3% to 6.6%, even though the macros are favorable, liquidity is coming back, commodity prices are benign, and globally bond yields are sitting at record levels, record lows. What is going on? Why is there such a large divergence?
Yeah, hi, morning. So yes, this indeed is a divergence. Some part of it is explicable, some part of it is inexplicable. So let me try to articulate the reasons which the markets are worried about. Firstly, yes, you rightly observed that fiscal deficit is under control. But if the government were to combat a slowdown in the economy, will it, actually breach the line of fiscal discipline and announce further steroids into the system? And if those steroids would mean additional borrowing, would it therefore lay some more pressure on bond yields? That is the moot question on the investors' minds in India at this point in time. Second, we are again, in a limbo with respect to the sovereign bond program, which was announced in the budget. Again, that remains to be, a mid-path, which markets are not very convinced, or markets are not completely sure that it is going to find its culmination. So that again would mean another round of small demand leakage. So that is another key question in the investors' minds, and that I think is probably creating a tug of war in bond yields at this point in time. The good news, but definitely, is that the global factors are trying to create that sort of a downward pressure on bond yields across the world, and I don't think India would be an exception. So hopefully, with the bond markets consolidating, we could actually start to see yields heading lower, assuming some bit of this conundrum, at least for the local bond markets, subsides.
Assessment, does it seem like, just going by the way the yield curve is moving, that recession in the US is impending and it will happen sooner than later?
I think that no, it is not. A recession in the US is not imminent, but I think there are a few factors. We are adjusting to a new inflation paradigm where we have seen structurally inflation is coming down. The second is that the impact of QE, etc., is still weighing on the yield curve. And the third is that there is an extreme amount of uncertainty. Now, what is very interesting is that if you look at the US yield curve, the data that's come out, the real economy data, for example, the retail sales, they do seem to be at odds with sort of, signaling and vis-a-vis recession signals. So that's clearly at odds right now. So it's too early to say that the yield curve at this point in time is really signaling a recession. It is conceivable that it is signaling a lot more uncertainty in the global environment than in the US right now.
Sanjay, if last time when interest rates were at this level, we saw there was a huge change which happened towards global liquidity, which is that central banks, they kept on lowering interest rates, money moved into commodities and it moved into emerging markets. This time, now that interest rates have come down decisively at a global level, which way do you think flows would move? Sanjay?
The carry trade currencies would sort of benefit. We will also see some money move into commodities. But I think it would also be fair to say that the difference between last time and now is that if you look at volatility and you look at sort of what is happening at a broader level, which is, the U.S.-China trade tensions, you've got problems in Hong Kong, all sorts of things that are happening, potential for a no-deal Brexit. I think, so the flows in terms of magnitude are likely to be sort of smaller than before.
Laxmi, whereas we are talking about this inversion in bond yield, an inversion in bond yield, just for our viewer, is an indication that recession is coming. But do you think somewhere we need to be cognizant of the fact that commodity prices have remained low for a long time, and if global liquidity this time moves into soya, cocoa, orange juice and other soft commodities which have been slightly benign, all the assumptions of a global recession will completely, evaporate?
No, so if the yield curve is inverting, it does not mean that recession is going to start hitting the economy, in this case the US economy, maybe today, tomorrow. So if you go historically and look data from maybe say 1980s, because some of us were not part of markets then, and then you realize that every time the yield curve is inverted, there is a lag of at least about 18 to 20 months before the economy actually officially moves into a recession. And also in that period, you really don't see any rout in asset classes, including equities or commodities. This time on, what we are seeing is something similar. The yield curve inversion has got to do maybe some bit of slowdown, some bit of trade war. It's also got to do with the other economies slowing down. Look at what's happening in Germany, look at what's happening in China, look at what's happening in Japan. In fact, Japan has actually, exceeded US Treasury holdings ahead of China, and this happened again about a couple of years back. So my sense is that, reading too much into the recession, while we need to be cautious, maybe excessive paranoia may not work. But one asset class, apart from the agri commodities, which is cocoa, soya, etc., one commodity which is actually seeing, a rush to buying is actually from the central bankers or from hedge funds or long only funds, is actually gold. It's actually crossed $15 per ounce mark, and looks like, as more and more there is this race to bottom in global central banking, you are actually seeing negative interest rates drive that money into this commodity called gold. The economy, including the agri economy, specifically in China or in the US, for example, is continuing to remain a little bit sluggish. So therefore, the momentum flows, though, might go into these commodities, but to expect a sustained flow may be really difficult.
May for a moment deviate from the bond yields and even draw your attention to what's happening with the currency. The rupee, the worst performing currency in Asia in the month of August, and the kind of slump that we've seen vis-a-vis the US dollar. There have been a number of factors, of course, that have contributed to this. What exactly is your outlook on the currency in these times? Laxmi, that was for you.
See, I think 15 days of, a rout in currency or a small sell-off in the currency does not render it to be a very precarious situation. If you look at year-to-date 2019, among the EM packs across the INR or the Indian currency has stood reasonably tall. We also have seen positive net sales into Indian equities by foreign investors. As we speak, for the entire year to date, we are close to about 56,000 crores of positive net sales. Even the Indian fixed income number is marginally negative at about 2,500 crores. So I think if you put that on balance and superimpose the fact that Indian FX reserves, we are at about $430 billion, all this does not bode really very negative news from a currency standpoint. But yes, in this entire turmoil, the US dollar, despite the noises and the appeals for rate cut is increasing in the US. The dollar continues to stand tall, and therefore it's natural that the EM currency pack, including the rupee, is under pressure right now. But we think that there is going to be an orderly movement in the currency, small depreciations withstanding. The broader outlook for the near and medium term would be that the currency would be range bound. There would be no palpable disruptions on either side, be it an aggressive appreciation or an en masse depreciation.
Laxmi and Sanjay, thank you very much for joining us.